So the total depreciation is going to be the depreciation for the existing finance leases plus the depreciation for the new leases. So it's going to be equal to, take the sum of whatever we calculated for the existing right of use assets, then we sum the depreciation for the new additions to the right of use of assets. We have that in place. So we can fill this formula to the end of the decade. And then, so now calculate to determine the ending balance for the right of use asset is going to be equal to, take the opening balance plus the net additions, and then we deduct the total depreciation expense. So we can fill that formula right to the end of the projected period. As you can see, we have the opening balance here as well, filling in, since it's a corkscrew calculation. So we have $31 billion. It's going to be depreciated for 10 years, and we have the ending balances here calculated for us. So we have those in place for the existing assets, and then for the new assets, we also have additions that we added, and we have that also calculated in total depreciation expense, and we have here the ending balances for both the existing and the new additions. So we have that in place. So this later one will impact our total property, plant and equipment balance, which we're gonna be adding this later on to the PP&E balance, which we will construct from our property, plant and equipment schedule. So we're gonna be doing that later on. So now we are done with the right of use assets for the finance leases. Now we want to go to the finance lease liability schedule, where we're gonna be demonstrating principal and interest repayment of finance leases. So in order to do that, we have some raw data that was given to us that we were able to collect from Amazon's public filings on its 10K. So here we want to bring in the ending balance for the long-term finance leases. In this case, where we go to the raw data tab, we go all the way down. So for the right of use asset, for the finance leases, we have the finance lease liability here. We have the closing balance here. So we have to reference the closing balance, and we can fill that right. And for the historic period, it's going to be a corkscrew calculation, where the opening balance is equal to the prior period's closing. So we can only fill this right for the historic period, since whatever will be left to as the opening balance to be paid for the finance leases is going to be based on after when we have accounted for any current portion of finance leases. So if there is any current portion, we're going to deduct that from the ending balance. So for whatever is left, it's going to be the balance which is going to be repaid in the future. So for now, we can just reference here the beginning balance. In this case, have it right here. So we just reference the beginning balance here. So we have that in place. So we can also reference the current portion of finance leases. So in order to do that, we will just go to the row at the top as we did. We'll reference here the current portion. Just make that in negative so that we are deducting any current portion for the finance leases. So we can auto sum that to get the total. So this, whatever is left at the end of the historic period, is going to be used to repay the beginning. It's going to be the beginning balance of the opening period for the year 2021, which is the projected period beginning going forward. So we're going to be paying $18 billion going forward. So that being set up, we can now begin modeling the interest, which is going to be based on the opening balance. So in order to do that, we will set this to be equal to, we take the opening balance and then we multiply that by, we go to the control panel, multiply that by the interest rate on the finance leases. So we multiply that by the interest rate. So we have that in place there.